there are certain things, they're called life events. When you're enrolling, we have life events. We also want to just emphasize, take the time that your employer gives you to make the decision. Generally, you're going to have about a week to make a decision. I think that that's the shortest time that I've seen. Sometimes it's 2 weeks for an open enrollment period. But certainly take the time that you need to consider your options. Understand that you're making these choices for the entire year unless there is a life event. I would also ask your HR person, if you do have any questions, if there are any kind of things that are very vague to you or just complex, make sure that you reach out to your HR person to ask those questions. So life events, the only time that you can make a change outside of a high deductible health plan and an HSA, which we will get to, is if there's a life event. So a life event is if you have the birth of a child, the adoption of a child, if you get married, divorced, if your child ages out at the age of 26, or if there's a change in household coverage. I have coverage, my husband has coverage. If one of us was to lose coverage, that would be a life event. So we will keep moving forward. All right. Things that you want to consider when choosing a medical plan. You will have an option, and we'll get into the different types of medical plans, but generally you're going to have an option between two different plans. If you work for a very small company, there might not be a choice other than the level of plan. However, you do want to consider some things when you're choosing a plan. How often do you go to the doctor? What do you go to the doctor for? Who are you covering? What is your family health history? Are there things that you really should go to the doctor for on a fairly regular basis? Do you even get close to meeting that deductible or that out-of-pocket max each year? Are you planning to have kids this year? Are your kids going to age out this year, which might be a celebration for you? Are you planning on having surgeries? These are some of the things you want to consider when you are deciding on the medical plan. So let's get into the types of medical plans that are offered. So HMOs, there are still some HMOs that are offered. This is kind of an oldie but a goodie. They're not as popular anymore, so you might not see these in your employer's offering. However, if you do, just understand that your primary care physician is the central of your health care for an HMO. And what that means is that if you need to go to a specialist, it has to be referred by your primary care physician. So you have to have a primary care physician within an HMO. It really has probably the least freedoms of all the plans that we're going to go over right now. A PPO is called a preferred provider organization. This one does give you a lot of freedom to choose any provider that you go to, whether that be primary or secondary or specialist. There are no referrals that are required within a PPO, so you don't have to go to your primary care in order to go to a specialist. And in some plans, gynecological is a specialist, so that is actually a good thing there. A POS is a point of service. So it really is a blend between an HMO and a PPO. So there is some freedom to choose the providers within your network. In some cases, you do need a referral to a specialist from your primary care physician. So it's in this type of plan, you want to make sure that you have a designated primary care physician. The last one is a high deductible health plan. So this one aligns with a health savings account. This is probably the one where you're managing your medical dollar the most because you're not just going to the doctor and paying a copay. You're going to the doctor and actually paying for the cost of the visit until you reach that deductible. So they tend to have, as they're called, high deductibles. But once you've met that deductible, generally it's either everything's covered 100% after that. Some high deductible health plans, once you hit that high deductible, say it's $4,000, then there might be a small copay below that until you reach a max. And we can go through that. And as I said, that aligns with a high deductible or a health savings account. All right. So some of the things that are within a health plan, and some of this is most people know, but just to make sure that we're all on the same page, premium is the cost that you pay per pay period, per month, to have the benefit. This is generally, it's a pre-tax benefit, so it lowers your tax liability. Once you're enrolled in that plan, you cannot reimburse yourself for premiums. If you're on an HSA or an FSA, you cannot reimburse your premiums. Deductibles, your plan, any plan that you're in is going to have a deductible, and it's the required amount that you have to pay before other coverages take over. The exception is preventative care, and we'll go into what preventative care is. Then there's copays and coinsurance. So copay is when you go to the doctor and you're paying $25, or if you're in a high deductible health plan, you're paying for the cost of the visit, say it's $200. And then coinsurance is the percentage after you've met your deductible. So say your deductible is $1,500 and your coinsurance is 20%. That means the plan is paying 80% of the cost and you are paying 20% until you hit an out-of-pocket max. So those are the key components of any medical plan. All right, what is, and I need to get that out of my way. There we go. What is a preventative care? So preventative care is covered at 100% on any plan that you are in. And preventative care is getting those routine physicals. It's getting those well baby or well child checkups. It's getting your mammograms and your colonoscopies. It's those things that help you to maintain and manage your health, and it helps to reduce the risk of diseases and gets you towards like early detection for any health problems that there might be. So understand when you go to the doctor, I encourage you to get routine physicals. I encourage you to get those mandatory things that you should get at specific ages, because they really, they can help and they're covered at 100%. All right. Health savings accounts. So we're going to talk about health savings accounts, which are only aligned with a high deductible health plan. And then we're going to talk about flexible spending accounts. So the difference in that S word is savings and spending, and we'll get into that. So health savings accounts, it's an arrangement that allows you to put money away to use to pay for your high deductible health plan. So it is pre-tax, and so it lowers your tax liability. You also use it tax-free. So if your high deductible health plan has a deductible of $4,000, you can put money away in your health savings account to help to pay those costs for the deductible, and if the plan has any coinsurances. This is very much, I like to equate it to having a 401k for your health. So once the money is put into a health savings account, it's yours forever, regardless of whether you stay with that company, whether you use that money. It transfers from year to year. Think of it as like having a bank account for your health or a 401k for your health. A lot of people, I encourage young people to get into this because let's face it, a lot of young people are not necessarily going to the doctor as much. However, they can bank all of this money and they can use it later in life because you can use it regardless of whether you're still in that employee-sponsored plan or not. So you own it. There are balance limits. So if you have an individual high deductible health plan, the IRS limits that in 2020 to $3,550, and then for families, $7,100. So if you and your spouse both have high deductible health plans, the maximum that you can contribute together is $7,100. So don't go in and say, oh gosh, well, I'm covering myself and my kids, so I can reach that $7,100, and your husband is doing the $3,550. You will be over. There are tax liabilities to that. You will get penalized. You want to make sure that you stay at or below that threshold of $7,100 in 2020. In 2021, they will increase. They generally will increase year to year. Right now, the 2021 limits are set for $3,600 for individual and $7,200 for family. There is a catch-up if you are over the age of 55, and that's $1,000. The catch-up hasn't changed in years. I don't foresee that it will probably change, but it does allow you to put more money into a health savings account to be used for medical purposes. Now, in order to have a high deductible health plan and a health savings account, you cannot be covered by Medicare, military benefits, or have a medical FSA that you're also using. And your dependents, you need to claim the dependents that are using that account on your tax return in order to be eligible. So I'm not going to really go into Medicare here, but I will mention this one thing about Medicare, that if you are in Medicare, you cannot be in a high deductible health plan. They kind of counterbalance each other from an IRS perspective. All right, next, flexible spending account. So while a health savings account transitions from year to year to year, a flexible spending account does not. It is a use it or lose it arrangement, both for medical and dependent. And we'll get to the dependent in just a minute. So flexible spending account is just that. You want to be very conscious of what you're putting into your flexible spending account annually, because at the end of the calendar year, and then sometimes there's a plan year, but it can be complicated. So we'll just talk about calendar years at this point. If you don't use it, it generally will go away. There are some caveats, and it's based on how the plan is actually arranged, and that's the last bullet on here. In some cases, your plan can either have 2.5 months. So on a calendar year, you have until March 15th to spend any money that was left over, but it has to be incurred in the calendar year. So if we're talking about 2020, any money that you set aside in a flexible spending account for 2020 has to be spent in calendar year 2020, but you have until March 15th to reimburse yourself. The other caveat, and you can have one or the other in a plan design, is the IRS has allowed, it's been a couple of years, has allowed carryovers of $500. So say you have $1,000 left in your flexible spending account, and by the beginning of December, you're like, I think I can spend another $500, but there's that $500 that I don't have medical expenses that I can reimburse myself for. If your plan is set up in such a way to carry over the $500, you're actually okay, because it will carry over to the next year, and that $500 will not count towards your max for that next calendar year. So you can use flexible spending accounts for any medical related issue. You can also use it for dental work and vision that isn't covered under those plans. So the maximum in 2020 is $2,750. They haven't disclosed what it's going to be in 2021, but generally, if we look at the trend, it usually goes up about $50 every year. All right, just a quick overview of some of the things. This is not an all-inclusive list that is covered or that you can reimburse yourself for on flexible spending accounts. You can also go and Google this, and in most cases, your provider can provide you a list. There again, it's never going to be all-inclusive. All right, also on flexible spending, there's dependent care. All right, so let me make one comment about medical real quick. The medical portion of a flexible spending is kind of like having a credit card. So say your balance is, you've obligated $2,000 for the calendar year. Because you've obligated that $2,000, you can spend up to that $2,000 even though you have not contributed to that account yet. However, a dependent care flexible spending account is more like a bank account. You can only use what you have put into the account. So a dependent care flexible spending account, also pre-tax, it can be used for any dependent care services, preschool, summer camps, before, after school care. It can also be used for adult daycare if you have a dependent child, or there is a family member, sister, brother, that you claim on your taxes that is you're the guardian of, then and they go to an adult daycare. You can also use it for that. It is also a use it or lose it. There is no carryover from year to year. The maximum that you can contribute to that per family is $5,000, and it is a use what you have. So if you're doing it on a per payroll basis, say you're reimbursing yourself on a monthly basis, you're reimbursing yourself in equal increments. A lot of people just keep their receipts for the whole year in an envelope, and then they submit their reimbursement at the end of the year. $5,000 doesn't take you very far for preschool or summer camp or before or after school care or adult daycare. However, it can offset the cost. All right, just a little blurb on what is covered: childcare up to the age of 13, anybody that is under your care as defined by the IRS. All right. One other thing that you may see in your your open enrollment is an HRA, not to be confused with an HSA. So an HRA is a health reimbursement arrangement. So this is an employee-funded health benefits. It usually is there to help offset the out-of-pocket expenses. So where I have seen these in the past is, say your current deductible limit is $1,500, and based on renewal rates and all of that, your employer, the best that they can do next year for deductibles for an individual is, say, $2,500. That's a big increase. $1,000 is a big increase for a deductible. In some cases, they will set up a health reimbursement arrangement to reimburse that difference, so that $1,000. And I have a graphic that kind of explains this. I have seen this in several plans. It just helps to offset it. The employee still needs to pay that deductible, but they can reimburse themselves. So this is how it basically works. The employee pays 100% of the first, in this case, we'll say there's a $2,000 deductible, pays 100% of the first $1,000 in the $2,000 deductible. The employee reimburses them 100% of the remaining $500 to $1,000. So we'll just build this real quick. So the deductible in this case is, I'm sorry, is $1,500. I forgot what my graphic looked like. The deductible is $1,500 for individual, $3,000 for family. Your out-of-pocket max is $4,000 and $8,000. The employee they pay that first $1,000 or that $2,000 on the family side. They pay that extra $500 in deductible, but they can reimburse themselves, or they can submit for reimbursement. Most cases, you actually have to pay it and get reimbursed. I have seen it. If you have an arrangement with your doctor and say you've had a couple of medical procedures and all of that kind of stuff, and you meet your deductible, say by July, you have an arrangement with your doctor that says, okay, my deductible is $1,500. I am going to pay the first $1,000. I'm going to submit my explanation of benefits to my to my employer through the carrier for that extra $500. So I'm going to pay the first $1,000, and then I'm going to pay the next $500 next month or the month after that, or something like that. It can be very complex, but it actually is fairly simple. You're paying the deductible, and then you are submitting for reimbursement up to the max for that reimbursement arrangement. Oh, there's the last little bit. All right, so this is basically how it works. You go to the provider, you explain that you have an HRA, you your provider files with the insurance, you submit your explanation of benefits to your administrator with a claim form. Generally, there's a claim form, and then you get the reimbursement and you send it to your provider. It can be that easy. I will say that the first time you have to do it, it can be like, oh gosh, what do I need to do? But if you just step back and say, okay, I know that I owe this money, what can I also get reimbursed through the administrator? All right, as we move on, telemed. A lot of companies are offering telemedicine. This actually is such a fantastic benefit both for the individual and for the company. And I will explain that. So telemed allows you to actually, for routine things, this is not for if you have if you have diabetes, or if you have something that is more, is not outside of routine. Telemed does not work for complex medical conditions, but it does work for common. You know when you're having an allergy attack, you kind of know when you feel like you have a cold or the flu. You definitely know when your child has an earache, and generally they'll get an earache in the middle of the night outside of doctor's visit hours. We also don't love taking time off to go and sit in the doctor's office. So telemed is fantastic. It allows you to either call or access online a doctor that is registered in the state in which you live to provide basic medical assistance. So I encourage people that are offered telemed. It generally doesn't cost you anything until you use the benefit. To go and register all of your medical information, so that when you have to use the telemed process, you don't have to then go do that while you're also trying to, cajole a crying infant who has an ear infection or something like that. So you call or you get on the web access, whatever is offered to you. You're generally triaged, which gives them the information of why you are seeking medical counsel. And then they generally will call you back within 30 to 45 minutes. Sometimes it can take up to an hour. I haven't really seen it take more than an hour, but they do let you know about how long it's going to take. You then talk to a doctor, and that doctor can prescribe back to the pharmacy in which you would like to get your prescription. Now, this is basic stuff. This is not, I've run out of my insulin for diabetes. This is not, I've run out of my heart medication for my heart condition. It's not for things like that. It really is for things where, hey, I was outside and I got stung by a bee, and I'm not really allergic, but I'm having an allergic reaction right now. Can you call in a prescription for an anti-inflammatory or something like that? I highly encourage people to use telemed. It is a convenience to you, and it's a convenience to your employer, because you're not going to the doctor as much. Therefore, your use of medical benefit is a little bit lower, and you're going to a telemed doctor for those routine things. So it does help to draw the renewal of medical down because of how it is used. So I highly recommend telemed. All right, medical scenarios. I've given you a lot of information. How do you choose what you want to do? So medical scenarios. You're 25-year-old, John's 25, he's single, he goes to the doctor every year for a physical, which is covered by preventative care. He doesn't have any major medical issues. He would be a great candidate for a high deductible health plan, because he's really not using the money that he has to pay. If he's just going for a physical, he's not paying towards a copay or a deductible. He can put money aside for the future. He'd be a great candidate for a high deductible health plan. Okay, Megan. 30, recently married, planning on having a baby in the next year or so. She goes to the doctor for routine physicals. She also sees a dermatologist on maybe every 6 months. She could probably benefit from both plans. a PPO, an HMO, or a POS plan is really easy to use. You know what to expect. You go in, you pay a copay, you see the doctor, all of that. It doesn't take a lot of kind of understanding how you're navigating medical. High deductible health plan really also could be really fantastic because she's only going for these certain visits every year. So maybe her deductible is $2,000, $3,000, and she maybe is paying $500 of it, and she's putting money away towards her health savings account. So she's using her health savings account for these scenarios, but she's also putting money away that she can use in the future when she does have a baby. Last scenario, Nathan is 40, married, 2 kids, age 4 and 8. He and his family have their routine visits, which are covered by preventative care. His kids are really highly active in sports and go to the urgent care a lot. He and his wife are expecting their 3rd child. For ease of use and to manage medical costs, he might want to enroll in a PPO or an HMO or a POS, whatever is offered by his employer. Because a high deductible health plan does mean that you have to pay that full deductible before the plan will start paying 100% or 80 or 90% based on how the plan is set up. If his kids are really active and from a money management perspective, maybe the high deductible health plan isn't his best option. It could be. It's just all about how you're managing your medical docket. All right, dental plans. All right, dental plans are pretty easy. They're pretty standard. Generally, an employer is offering coverage between $1,000 and $2,000 a year. It is per participant generally. There's always going to be 3 levels within a dental plan preventative. Encourage you to go get your oral exams. It includes the fluoride treatments, bite wing x-rays every 6 months, and all of that. Basic. If you have to get the full mouth x-ray, you have to get sealants on your teeth if you're a child, simple extractions, all of that. Major, you know, those crowns, the inlays, periodontal treatments, implants, anything like that. And I put the 180 and 50. That's generally what you see. The basic and major may differ a little in percentage of coverage. However, dental is pretty standard. You will have a dental card in most cases. I will say that dentists are not, don't have to be in a network like medical providers do. So you may have to shop for your dentist, or you may just have to say, hey, my dentist this year is outside of my network, and understand what the cost difference is. Sometimes the cost difference is minimal. Sometimes it's a little bit more substantial. There's always going to be a deductible. It's generally between, say, $50 and $100 per person, and it's only on basic and major coverages. Some plans will cover orthodontia. In most cases, if they do cover it, there is a limit, and it's a lifetime limit, and it's limited to your dependent children. I haven't seen many plans that offer orthodontia for an adult. However, there could be some. It's also a good place to use your flexible spending money or your HSA money if there's something that is not covered within your dental plan and you're participating in those medical plans. You can use those monies that you're setting aside for things like this as well. All right, vision. Again, very standard on the vision plan. Vision carriers, they generally don't give you a vision card. And they're pretty standard. They don't generally cost a lot. Most of the plans are going to have an eye exam. Now, understand that your vision plan does not need to cover an eye exam. There are some vision plans out there that are maintenance only. I tell you this because you want to make sure that you understand if it's only maintenance, and maintenance being the frames, lenses, contact lenses, things like that. If your vision plan only covers maintenance, I would ask your HR person if the health plan covers an eye exam. The eye exams generally are not terribly expensive. However, it's nice to understand that before you go to the eye doctor. But most plans are going to have an eye exam once every 12 months. Sometimes they'll have retinal imaging, again, once every 12 months. Most plans are only going to reimburse you or pay for frames every 2 years, but they will replace the lenses in those frames, and most of them will cover contact lenses, but generally it's in lieu of getting glasses. So if you're getting both glasses and contact lenses, there may be more of a cost to you because the plan covers one or the other. I would also look into what the enhanced coverages are. A lot of vision plans also offer enhanced coverages, such as, you know, certain eye surgeries and things like that. Also, look into the carrier and see if you, once you're enrolled in a vision plan, you can go on their website and there's generally discounts listed on their website. Also, there's discounts listed on medical websites, even though that say you have Blue Cross Blue Shield for medical and you have VSP for vision, you can go on to the Blue Cross Blue Shield website and look for vision discounts as well. Just a little tidbit. All right, getting to the end of this, and I'm trying to go very quickly so that we have time, because I'm probably way over time right now. All right, short-term disability. Generally, your provider or your employer will provide short-term disability and long-term disability. Generally, there is an elimination period. That is just the number of days that you have to wait until your benefit cuts in. Generally, the payout is 60 to 62 2/3 of your weekly income. There is a maximum. Generally, it's between 12 weeks and 180 days. It's based on plan design. In some cases, well, in all cases, your employer probably is paying for your short-term disability. They may offer a buy-up plan that would get you to 80% of your weekly compensation. Not all plans offer this, but just be aware if it does. And the buy-up would be at your expense. Long-term disability, the same way. You generally have to be, you have to go through the short-term disability elimination period in order to qualify for a long-term disability. And long-term disability is those things are not job-related. If you are injured at work, that is covered under workers' comp. That is generally not covered under a long-term disability plan, and they will ask you that. The plan also pays between 60% and 66 2/3. There's generally a maximum. Understand what that maximum is. This does not pay weekly, this pays monthly. And then the end of long-term disability is you either return to work or there's a reduction benefit duration period. Generally, it's about 5 years, or you reach Social Security normal retirement age. Again, in most cases, long-term disability is paid 100% by the employer. And in some cases, rare cases, there is a buy-up on long-term disability as well. Not always, but sometimes. Life insurance. Life insurance, this is to supplement the life insurance that you already have for yourself. This is not to take place of that. Group policies are not meant to be your sole source of life insurance. Generally, an employer will offer a life insurance policy. Right now, what I'm seeing is it's generally 1 times your annual salary. There generally is a cutoff. So if you are a high income person, it becomes a de minimis benefit for you. However, understanding what the coverage actually is. For smaller companies that maybe can't afford a one-time salary type of life insurance plans, I have seen plans that are offered that are just capped. It's a $50,000 plan or it's a $75,000 plan, but it's for everyone regardless of their salary level. It is covered at basic life and accidental death and dismemberment. So basic life, you actually pass, there is a payout of the benefit coverage. Accidental death and dismemberment, there would be if say you died in a car accident, it would be basic life and accidental death and dismemberment. The dismemberment is you live, but you're you're reduced on how you navigate. You're unable to work and things like that. That's the dismemberment portion. Group life is generally covered 100% by your employer, not in all cases, but in most cases. And in some cases, your employer will offer you voluntary life for you, your spouse, and your children. That is paid by you as the employee. And understand that not all companies offer voluntary life. There is a minimum guarantee. So that means that you have to have at least 10 employees that are within your plan, and then you have to have a certain percentage of those employees that actually will enroll in voluntary life in order to be able to offer it. Last but certainly not least, well, we're getting there. Supplemental plans. Your employer might offer supplemental plans. And this is just a list of some of the supplemental plans that I have seen in the past: accident, critical care, cancer, hospitalization, life, disability. These are completely paid by the employee. These are offered by an employer, but the employer generally will not pay for them. They are completely portable if you leave your employer. They are just there to be able to offer you anything else to supplement your life. So accident being something that your medical insurance or health insurance doesn't cover. It generally pays a cash benefit. Critical care, there's something that's life-changing in illness. It can help to get you back on your feet. Cancer, we understand what that one is. That one can be, a huge financial and emotional travesty, so that it helps in a financial way. Hospitalization. Then life, if in some cases people will do supplemental life because they have health conditions that preclude them from getting their own life insurance, and the group life is not enough for them. And then disability as well. Last but not least, employee assistance plans. So I encourage people to use this as well. It's completely anonymous. Generally, you don't have to pay for this coverage if your employer is offering it. And it helps you with like day-to-day living. We're all living through a pandemic right now, and we might have issues that we want to talk to a third party about. We might want to stop talking to our spouse about being at home all the time, and we might want to talk to someone else. It can also help with legal things. So if you are looking to get a will drawn, or a medical document or something like that, financial support, you have just had a life change, a divorce, something like that, and you need to understand how to manage finances, they offer things like that. And then just well-being. Understand that employee assistance plans are not, they're not long-term. Generally, it's between 3 and 8 coverages that are covered by the employer under an employee assistance plan. It's completely voluntary to use this. It's also completely confidential. From an HR perspective, the reports that I receive back is just that people are using it. Not what they're using it for, not who is using it, not how many times they've used it. Just that they're using it. So it's a usage report that your employer will get. If you do need to use this type of benefit and it goes past whatever that limit is, whether that be 3, 4, 5, 6, 7, or 8, whatever your plan offers, they will refer you. It then becomes a cost to you if you want to continue that assistance. All right, I am going to stop sharing. And awesome. That was the entire thing, and I am totally open for questions now.
Molly, thanks so much. What great information shared. I took a page full of notes myself. Gosh, just the differences between HSAs and HRAs and the flexible accounts and what you can and can't use them for. You use it or you lose it. I think it's safe to say there is some risk in not fully understanding your employee benefits. Is that right?
There is, because once you've enrolled, unless there's a life event, you can't change it until open enrollment.
Certainly. And it's funny, in your case study, you were talking about Nathan, and it's like you were speaking to me directly with a 4-year-old and an 8-year-old. My 4-year-old is my daredevil, and they know us at Urgent Care by our first names. So hopefully we don't repeat that. But we did have a few questions come in, and I want to take our last bit of time to cover some of those. And the first question was, Molly, do you feel like the selection of physicians is more limited on a non-PPO plan? Great webinar, thank you. So that's a curious question. Molly, do you think when you compare the different types of plans, do the different plans have a better selection or a lower selection of available physicians?
The available selection of physicians is based on your carrier, not necessarily your plan. Okay. So Blue Cross in North Carolina, Blue Cross Blue Shield is a major provider. There's almost every doctor or provider takes Blue Cross Blue Shield. However, if you have Cigna or Aetna is a good example in North Carolina, there might not be many providers. So it doesn't matter if you're in a PPO or an HSA, it matters the carrier. Gotcha.
Very good. Next question is, my 25-year-old is on my insurance plan. Does her coverage drop the day she turns 26? I had heard recently this age may be increased due to the pandemic.
I have not heard that it's going to be increased. Something for me to look into. Under normal circumstances, the day she turns 26, she cannot be on your plan anymore.
Gotcha. Very good. Another question. What do we need to consider if both spouses are working with different medical coverage options? This is more common, today. Mm-hmm. Is it better to be covered separately or on both plans? What about dependent coverage? So when you're talking with couples, that are each eligible for a medical plan, what kind of guidance can you give?
The guidance that I give is look at the plan design. You're always going to get a plan design when you're doing open enrollment. Even if it's an automated process, there are links to be able to look at the plan design. I would then choose the best plan design and the cost, the out-of-pocket cost. My husband and I have always been on individual plans because it costs less for me to pay for individual coverage under my company, and it pays less for him to pay for individual coverage under his company. Mm-hmm. We don't have children, so we don't have that dynamic. However, I would look at what is the cost and what is the plan design and what is going to be best for your family. You can split the kids up if you need to under different plans, or you can say, we're gonna do a family plan under my husband's plan. Now you have to also consider this. There are some companies, it's maybe a little harder to enforce, but there are some companies that if your spouse is employed and their employer offers a medical plan, you have to get a spousal waiver to cover your spouse on your plan if they have eligible coverage under their employer. So just something to think about.
Yeah, great information. The last question that I believe we have so far, and you covered part of this a little earlier. My spouse lost his job 7 days ago. If I add him to my healthcare coverage, do I have to do it within a certain time frame?
You do. Yeah. So you have 30 days to add any dependents to your plan. From the date of loss of coverage. So if he lost his job 7 days ago and the plan he was on terminates benefits the day he leaves, you have 30 days from that date to get him on. In some cases, if he lost his job 7 days ago but his benefit pays through the end of the month, you have a little bit more time.
Gotcha. Very good. I know these answers are super beneficial for our attendees. I'm looking to see if we have any more that have come into the inbox, and I don't see any at this point. So what I'll do here, Molly, is number one, I want to personally thank you for not just your time, but thank you for the preparation and all the information that you brought. It's a tremendous benefit, to us and our client family here at LifeTime and Limmer Wealth Management. So I can't thank you enough for that. For those of you in attendance, I mentioned earlier, this is just episode 1 of our Lifetime Learning Series. Our next webinar is actually scheduled for September the 17th, and we are covering the basics of estate planning. So we hope to see a lot of you back for that. And this is not just for our clients. We encourage you to invite friends, family, colleagues. Feel free to share the merrier, and we look forward to seeing you again in the very near future. So Molly, thanks again for your time. And to the attendees, thanks for spending an afternoon with us. Be well, stay safe, and thanks for your trust you put in LifeTime.
Thank you.